welcome to BloombergQuint. We're done with the last policy review of the calendar year. It's been quite the year, so perhaps in some ways it's good that we got a relatively uneventful policy, no change in interest rates as expected, no change in stance as well, and even the fear that the RBI would signal withdrawal of some of the surplus liquidity did not play out. So on all fronts, status quo. Joining us to talk about not just today's policy, but also some of the signaling beneath it and what lies ahead in the year 2021. We're joined by Pranjul Bhandari, Chief India Economist at HSBC. And we welcome back to our screens Shubhada Rao, this time founder of Quantico Research. I'll digress for a minute and say welcome back, Shubhada.
Thank you, Ira. Thanks a lot. Great to connect all again.
All right, let's dive straight in. Pranjul, let me start with you on the immediate policy response that came through. I think all of you had predicted that there'll be no change in rates. There was some fear that there could be slightly less dovishness on the guidance, but even there, they stuck to the October script.
Yes, completely right, Ira. And honestly, that was really what we were expecting. Over the last couple of months, the RBI has been facing the impossible trinity. It has been juggling between competing objectives of keeping inflation low, keeping bond yields low, keeping the rupee from appreciating in the midst of an economic crisis. And I think it came to a point where it had to choose sides, and it had to do that this time. And it clearly chose economic recovery over inflation for now. The truth is that, we think that this is probably the easiest or the loosest policy that we'll see. I think going forward, RBI will start to have to talk a little bit about normalization. And the reason I say that is because I'm a little worried about inflation. It's so far the dominant narrative has been that, look, there are supply side constraints, and once they ease, demand is weak and therefore inflation will fall. But this dominant narrative is not coming to bear, and it's been 6-7 months now. In my view, there are problems that are more deep seated. One is the disruption of the informal sector. Informal sector makes up 50% of India's GDP, and the huge disruption it has seen through the lockdown period means that many small firms have ceased to exist, and I think that is weighing on inflation. Now, the truth is that informal sectors actually come back into play. There's high death rate, but there's also high birth rate of informal sector. But that period between when they have gone away and before they reappear can be a period of high inflation. It's supply side, but if it lasts for too long, it can become entrenched in inflation expectations. And then it doesn't matter if it's supply side of it or if it's demand side. It just means there's high inflation to deal with. And I think that's one of the problems we are facing with. The second problem, I'll take 30 more seconds on inflation, is services inflation. I think once the vaccine comes into play, a lot of people will begin to move around demanding a lot of services that it did not demand in 2020. And what we may see then is high services inflation. India has had a troubled past with services inflation, and that could be inflationary as well. So I think these are some of the problems that RBI will have to acknowledge in the next policy meeting, and probably shift gear and start a normalization process, although a sort of a gentle one.
And I'll come to some of these in slightly deeper detail. Shubhada, we've always relied on you for sort of definitive inflation analysis. What's your sense right now? In some ways, I think they probably felt that it's too early to rock the boat, and I get that. But if you look at what they have said on inflation, it's sort of very wishy-washy and unconvincing. On the one hand, they're talking about supply side, they're talking about margins being built in, no sense of how quickly that will ease. Then, of course, they do acknowledge that oil and metal prices are starting to go up. I wasn't clear on the inflation analysis at all.
Yeah. No, I think this time round, RBI was grappling with not a very conventional inference as far as inflation drivers was concerned. We've had supply shocks, we've had raising of duties on petroleum products, we've had unfair or uneven competition, also distorting price structures. So I think the classic conventional inference was absent as far as RBI's reckoning was concerned while going into inflation, defining the inflation trajectory. trajectory. But having said, I concur that there are 2 or 3 factors that probably needed more of convincing articulation from the central bank. One being that they are hinging their expectation on the Kharif output, flooding the markets, and at least the perishable price pressures easing off. But we've seen that they're having idiosyncratic factors which have actually fallen by the side and not really played out as per RBI's expectations. The second factor that I feel was fairly lacking in commentary was the analysis on core inflation. I'm sure the committee has gone through a rigorous discussion over the core inflation drivers, but as far as the policy statement was concerned and communication was concerned, I believe that they could have done a little bit more on the core inflation commentary. Having said, the numbers, the forecasts that they have presented are quite real in terms of the second half of the current fiscal remaining extremely elevated, significant upward revision in inflation. Also going into the next fiscal year, they have their lower base of inflation is also at 4.6. So I think uncertain drivers are there, but as far as inflation commentary was concerned, probably a little bit more of analytical rigor could have been shared with the outside world.
Okay. I'm just, I'm going to switch focus to growth before I come back to the longer term issue of, what this says about the inflation targeting sort of dominance in monetary policy. Pranjul, on the growth side, I think, they've said now 7.5% contraction. That seems to be based on what you saw in Q2. Is that pretty much along the lines of what, you're thinking in terms of the trajectory of Q3 and Q4 as well?
Well, look, before I sort of get into that, I just want to make one point on growth. There's a big difference between the growth number that the CSO will come out with and of which all of us make forecasts, and then growth on the ground. We know that the CSO does not have very good indicators of the informal sector, and it proxies the informal sector with formal sector data. This works out in a normal time, but this is not a normal time. We know there's enough evidence that the informal sector has been hugely disrupted. So any forecasts that we are making of what CSO will come out with is not a real indication of growth on the ground. It's a slightly fluffy number. But having said that, I think what the RBI wanted to express was that the third and fourth quarter will be much better. In fact, they went out to say that it could be positive in the third and fourth quarter, the second half of FY21. My sense is that, it's a tough one to call because, what worked out for growth in second quarter was this combination of pent-up demand, festival demand, and huge amount of household savings that needed an avenue to come out. But some of this pent-up and festival demand will fade. And I think what we are really banking on for the second half of the fiscal year is fiscal spending. Year to date, central government fiscal spending has actually grown 0% year on year. The hope is that after announcing some support packages in the last couple of weeks, this spending will go up and will support growth and will make up for the fact that we don't have this festival-led demand anymore. Yeah. So if that fiscal spending were to happen, then, I think, we're looking for better numbers in the third and fourth quarter. I'm not as optimistic as RBI, but I'm optimistic as an RBI has a yearly average of 7.5%. I have a yearly average of 8.5% contraction.
Shubhada, what do your the growth numbers look like? Also, I guess this is what they're trying to do. They know they need to support growth, but inflation is not permitting them room for rate cuts. So I guess the best they can do is, stay accommodative, stay surplus liquidity, maintain easy financial conditions.
Absolutely. No, I think as far as growth is concerned, I think we are pretty much close to what even Pranjul is projecting. Our own projection is economy will contract by 8% plus. To be precise, at 8.3 is what we are looking at. Definitely, we are also looking at a sequential improvement, but the speed with which the economy, picks up pace in terms of recovery is highly unpredictable. But yes, high frequency indicators do seem to point that there is going to be an uptick as far as the number numbers are concerned. Having said, I think by and large, everyone in the market went ahead with the expectation of status quo on rates, but some commentary on the liquidity, because clearly there were distortions at the very short end of the yield curve, with the very short-term rates being lower than reverse repo. So there was a wider expectation that the Reserve Bank of India will either signal or have a commentary to put forth a roadmap of how they broadly intend looking at liquidity going forward. None of that happened, and probably that was the euphoria. But I would just point everyone's attention to one statement, that while RBI has definitely committed its accommodative stance through this current fiscal year and going into the next fiscal year. Now, going into the next fiscal year does not, by tautology, mean that it is entire fiscal year. I think it's going to play it by ear. I think it's going to observe the growth inflation dynamics going forward and accordingly calibrate liquidity. So we believe that at this juncture, yes, it was an appropriate continuity that RBI adopted as far as the liquidity assurance was concerned. No doubt about it, growth particularly remains on high adrenaline on fiscal and monetary stimulus. There is no private sector led investment growth, and that RBI also pointed out. And that is the reason probably they need to continue to lend support to growth through their extraordinary liquidity and monetary measures. Having said, going forward, what are they likely to do? We believe that as and when the RBI gains confidence as far as inflation, if it plays out as per the expectations of food prices, easing off, they are going to begin to calibrate liquidity, and this need not be in contradiction to their accommodative stance. They will gradually start reducing the 6 lakh crore plus surplus liquidity bit by bit, step by step, and we believe that it could come through a gamut of tools, not just one tool. They could look at rupee appreciation and so on. We could discuss that at a later stage, but I would think that liquidity calibration is something that they will start tracking right now, right onwards from December to the March quarter. And going forward, I think post-budget, we could see the meaningful actions from RBI, because let's not forget, March is also the time where the MPC framework reviews the inflation targeting mechanism going forward.
Yeah, that brings me to the big picture question. So, Pranjul, I think, Maitri asked the question in the press conference, which is on everybody's mind. She asked it bluntly: have they essentially, for all intents and purposes, junked the, inflation targeting framework? She's right in asking that question. It does appear, I know these are very unprecedented circumstances, but you're not endeavoring to move towards the target. You're not even calibrating liquidity, accepting the underlying inflation pressures. So the signal you are giving out is that, look, we are growth supportive right now despite our framework.
Look, this is a tricky one, and I do have some sympathies for the RBI. It just, in its last policy meeting, spoke about a looser for longer sort of accommodative stance, and it's to change your stance every single policy meeting. To be fair, it also has come out with realistic forecasts, both on the inflation front, and also on the growth front. It could have dilly-dallied with that, but it didn't. It was fairly specific that it thinks that inflationary pressures have become adverse in the last 2 months. And the truth also is that maybe they are not showing all their cards in this policy meeting. The truth is that, they have a possibility of reining in liquidity without announcing it in any policy meeting, and sort of doing it in small measures between policy meetings. So I think I would like to give them some benefit of doubt here. But having said that, look, I do agree with you. Our own research shows that globally, in periods where especially emerging markets are seeing high elevated public debt, it's important to double down on rules-based policy making. Otherwise, over time, markets lose confidence in you, and you're sort of in a worse off situation than you would want to be. So I think that's really our responsibility now. It is a period in which public debt is very high, 90% of GDP plus. And at this point, we have to give the right signals that we are rules-based policymakers and not policymakers who sort of change in every policy meeting. So it's a tough one. My hope is that this is the last policy meeting in which it's all sounding so accommodative, and over time the RBI starts to employ steps by which it slowly starts to normalize by withdrawing the excess liquidity.
No, absolutely. And that point about sort of the flip-flop on policy is critical, right, Shubhada? I mean, there is this constituency which is saying that we shouldn't be in inflation targeting. We were a sort of indicator approach. All of that is fine. But my point always has been that you have accepted inflation targeting. And within one cycle, to start saying that we want to junk it, just it sends out a really bad signal on your commitment to inflation.
Absolutely. I think no way the central bank should be signaling that they are, abandoning the inflation targeting. For sure not. We all know the benefits of that have accrued to the economy on account of, anchoring inflation expectations around, say, central tendency of 4%. So nobody can take away those benefits coming out in terms of for the economic agents. Having said, I think, there are a couple of points that I would like to raise at this juncture, Ira. One is we have seen the developed markets like Fed also moving towards average inflation targeting. Now, I'm just mulling and maybe thinking aloud here that probably for India, we could definitely explore looking at something like an average inflation targeting, and it makes sense for economy like India, where you have a significant degree of volatility and variability in terms of month-on-month inflation drivers, particularly. And with that kind of average inflation targeting, at least we will take away the high frequency noises that could present themselves to the central bank, every policy meeting. So if they are to look at, if indeed they have to make it flexible, they could possibly look at average and inflation targeting, but no way that they should be abandoning the inflation target as such, because India has begun to do well, and it sort of paves a very predictable, sound environment for investment and consumption decisions.
Pranjul, I know it's a longer debate, and we'll have a longer debate at a later stage. But do you have a sense in your mind on the contours within which we're going to review this inflation sort of target or the monetary policy agreement? I think the governor today dismissed WPI coming back because somebody asked a question. So are we looking at CPI with a different range, wider range, higher range? Any sense?
Well, honestly, whatever I say right now would be speculative, because honestly, we don't really know what are the different options they are thinking about. But my own sense is, and my own preference is, that we stick to what we have. There's a huge amount of gains to be had by sticking to what we have, given that we've not really stuck to this for long. It's just been a couple of years. Also, it takes time for people to really understand what inflation target is. Sticking to this particular number of 4% in an interval of 2 to 6%, I think should be the way forward. That's my own personal view. Also, a word on all the unconventional things other advanced economies are doing. The world has obviously become very adventurous. Modern monetary theory, yield curve control, QE infinity, no more austerity. All of these things have become sort of the calls for the day. But the truth is that these are the calls for the day for advanced economies, who perhaps have got some amount of license to do all of this, because for years they have been, inflation targeters, targeting one particular number. Perhaps they've earned that right. I'm not sure emerging markets, can do that. I think emerging markets have a huge price to pay if they become very, very adventurous, price in terms of high inflation or in terms of more volatile and low growth. So I think we have to tread very carefully, not get carried away by what other central banks are doing, and just stick to the mandate we signed up for a few years ago. I think there are a lot of gains there.
Oh, absolutely. I'll just close off and come back to the more immediate concerns. So, Shubhada, tell us now, from here on, the focus shifts obviously to the budget. But broadly in FY21, do you see more sort of fiscal support to the economy as opposed to monetary support? Because I'm not sure whether there'll be much room there. I know we'll see very high growth rates, but I think all of you have taken pains to explain that the level of GDP will still be well below the pre-COVID levels. So there is still some support to the economy will require.
I think as far as fiscal support is concerned, Ira, my sense is it'll get a tad better in this quarter, the last quarter, because somewhere the government is also looking at positive GST numbers, coming into the coffers. Of course, it doesn't give them a dramatic, flexibility to spend away, but at least there would be some breather on the government side to be able to spend a little bit more. And I would expect one more round of maybe not very huge fiscal impulse or injection of support through budget, but there would be some kind of a support is what I'm anticipating in the quarter that is we are getting into. As far as monetary is concerned, I think the RBI front-loaded everything in terms of liquidity, in terms of monetary, and now what we would see is more of fine-tuning. Do not really anticipate any rate cuts, obviously, in fiscal 21, but we do believe that any rate action would be preceded by a lot of these liquidity calibration measures before they even think of anything on rates. So I would think that it could be more of fiscal rather than monetary going forward until the end of this current year.
Pranjul, last word to you, same question, the fiscal monetary mix in FY21.
Yes, I tend to agree with Shubhada. I think for the remaining 2 quarters of this fiscal year, there is huge room for fiscal expenditure to increase given the amount of tax collections that the government has suddenly got. It's difficult for the government to start new projects so quickly, but I think it can do a lot by just paying off some of the dues it owes, for example, to the fertilizer companies, things like that they already announced in the previous economic support package. So if they can get some of that spending done and some more alongside, I think that would be supportive of recovery in the 3rd and 4th quarter. I just wanted to add one more thing. I think going into FY21, at least the first, FY22, at least the first half of it, we may probably not need any major fiscal support or even monetary support because if we do see a vaccine come forth, we see herd immunity building, we see recovery rates from the pandemic rising, that itself could unleash private consumption, and there is a lot of savings to support that, and that could be a driver of growth for the first half of FY22. I worry about the second half of FY22 when the globally advanced economies will be coming out from too much fiscal and monetary spending. But that's of course a conversation for another day.
For next year, perhaps. All right, I'll leave it at that. Thank you both so much, Shubhada Rao of Quantico Research and Pranjul Bhandari of HSBC India. Thanks so much for joining us. Thanks for watching Bloomberg.
Always a pleasure.